Hey gang, Carl White here, and we are broadcasting actually in the studios today. And you're listening to Author Showcase powered by the Scotsman Guide. And we are interviewing today Mr. Joe Lydon, who is out of today, anyways, out of San Diego. And Joe, you wrote a great article in the October residential edition of the Scotsman's Guide, and it was called Capture Attention by Doing What Others Can't. So great title. First of all, Joe, great to see you here, brother. Thanks for hanging out with us today.
Happy to be here. Thank you.
Cool. So first of all, give us a brief, like, who are you and like what do you do?
Yeah. So I myself and a partner, Stu Marvin, run LendSure Mortgage Corp, which is in San Diego. We're a small mortgage banking company. We do about $200 million a month of non-QM mortgage loans, all residential. Been in the business a long time, but our principal focus is non-QM lending. So when we're talking with brokers who are principally oriented to doing conventional FHA, VA, they don't know much about non-QM, so a lot of times we've got to teach them what non-QM is all about and teach them basically how to get more loans closed for themselves.
Yeah. So how are you finding non-QM coming into play with, boy, the impact of the current low inventory of homes and the higher interest rates? That's had a major impact on the loan officers.
Yeah, there's no doubt. In fact, it's an interesting question because it comes up when we're hiring AEs to call on brokers. What's happened is if you go back, call it, the not including the last 2 years, if you go prior to that for 10 years, loan officers throughout the country they were in a good place because interest rates were just falling slowly from 6% back in 2008, and they just very slow decline. A quarter, every half year it came down a quarter. Broker could refi it, and it did that for a good 10 years. And so brokers, did well during that period of time. It was very difficult for our AEs to go knock on a broker's door and get their attention because most of them would say, I don't do business with non-QM borrowers. I don't have the time. They wouldn't give us the time of day, essentially.
Yeah.
Today, it's quite the opposite. Brokers want us to come in because they want us to describe to them the kinds of borrowers that we do business with. And then we help them kind of craft a new marketing strategy to get to those borrowers. But Carl, the reality is when I sit in front of a broker, I first start out and I talk to them about what my customers look like. And I usually describe some of the attributes of a securitization that we do. So I'll say, well, my average FICO with my borrowers 742. My average LTV is 67%. About 55% of or 60% of our loans are purchase money transactions. By this time, the broker's looking at me like I got a hole in my head, and they say, "Well, wait a minute, that's a pretty darn good borrower that you just described. And why would they do business with you?" And I then say, well, 55% of those borrowers came to us because they needed to use bank statements as an income approach. They could not get approved in conventional full doc, so they needed an alternative approach to the income. So after you get past that, then we have other reasons why people bring loans to us, but mostly it's around the income topic. Just a couple of examples beyond bank statements would be, the guy's got RSU income, and it's not he can't get a full 3 years forward. And the rule with conventional is you got to go 3 years forward. We'll give you a break and okay, we'll take it 2 years forward. Or we don't have a 1 year look back. It's brand new RSU, brand new job. We'll take that. So the truth of the matter is my borrowers are very good borrowers. Many of them are self-employed borrowers, But in terms of credit, they're very, very good. And the loans that we securitize, that we monitor them and they perform quite well. So when after I get done talking to a broker and they realize this, they realize, oh, okay, now I get it. And so they start thinking about the loans that they said no to because they couldn't get income documentation the way they needed it. So.
And do you find, you talked a little bit about this in the article, do you find that when the loan officer has these extra option available, right? Basically, they have more kinds of cereal on the shelf to sell, right? You're going to sell more cereal if you have more different kinds on the shelf. Do you find that makes it easier for the loan officers, like, to approach different referral partners, whether it's divorce attorneys or real estate agents or any others? Does that help with that conversation?
Yeah, and in fact, we teach them how to market for such borrowers. A lot of them start out thinking that we're doing business with rough credit borrowers. And the truth of the matter is, we really don't. I mean, the lowest FICO I can take is 620. The number of borrowers that we do business with that have FICOs less than 660, I can count on a handful. I mean, it's not really our target audience. However, our target audience might be, we do condo tells. Not a lot of people do. We do non-warrantable condos. So those are things that are very helpful to a loan officer, because a loan officer can then take that information and get in front of a realtors and say, hey, I've got an outlet for condo tells. I've got an outlet for non-warrantable. So having the knowledge for a loan officer is just huge, because he can then say, oh, I'm going to go call on these types of people. Well, most loan officers just call on real estate brokers. That's a given. But once I start telling people some of the products that they do, then they say, I'm going to go call on financial planners, because when you tell me you can do that type of loan, I'm pretty sure financial planners would be a good source to go call on. So, and it is calling on financial planners, calling on banks that say no. They have rigid boxes and they say no, but the borrower really looks good and he's just missing Fannie. Okay, so you get a referral from a bank. So I could give you a list of 20 different parties to call on if you're a broker who is used to doing conventional and now wants to start talking to people about doing non-QM.
I think it's interesting that the non-QMs, and I think it's a false perception that a lot of people have, which is why I heard you just say, this is not subprime loans. This is non-QM.
Yeah, it really, I mean, the reality is, I'm pretty sure that my loans, the loans that we produce, outperform what conventionals do.
Yeah.
Because I know they take deeper risk on the credit front. I think that is a misnomer. Back in the day, you had non-prime and then you had Alt-A. I've been doing this stuff for a long time. So, Alt-A was a very good product for a long period of time. It wasn't until the industry screwed it up themselves. I mean, when we took loan to values to 100%, and then at the same time we took credit down, those were two foolish things for an industry to do. But when you're doing, purchase money loans and someone's putting 30 to 35% down and they've got a 750 FICO, you can bet just with those 2 or 3 bits of information, that loan's going to perform. Now we have to have ability to repay, so we got to get to an income number. Usually we do that through whether it be bank statement program or a asset depletion type of product. But yeah, the loan, it's a real misnomer to think that I'm doing business with tough borrowers. So that's just like
subprime. Yeah.
No way.
You mentioned something a few minutes ago about that you guys do condo tells and non-warrantable condos. I know in the article you made mention of it, and people may or may not remember the name, but there was a condo down in Miami that collapsed here. I think it was earlier this year or last year. Recently, though, I think it was called Surfside, was the name of the place. Have there been changes in the condo lending post Surfside tragedy?
Oh, absolutely. The Fannie and Freddie's tightened that up in a major way. And that's why we're seeing more and more requests on the non-warrantable front. And so as Fannie and Freddie tighten up, that just means they're bringing their box in. And what I do is all about on the edges of Fannie and Freddie. Just everything's on the edges of Fannie and Freddie. And so that's a good thing for me. I get to look at more non-warrantable condos. Now, we do look at them. I mean, we understand that there's additional risk. So we're not saying yes to all of them, but we've got a underwriting rules that we've built, that we've shared with our investors, that we've shared with the rating agencies, and so we're able to do them. We take a little more risk, as is for all of our loans. We take a little more risk. Our pricing's anywhere from 60 to 150 basis points above Fannie Freddie, generally.
Right. So, but boy, right, pretty much right there. So, you also mentioned in an article about the bridge loans, and just in case somebody's brand new to the industry, explain just real briefly what a bridge loan is.
Yeah, well, I will. In fact, our bridge loan is very unique. Okay, and I'll explain it. So I'll just walk you through a scenario. A borrower owns a house worth $1 million, and he owes $250,000 on it. So he has $750,000 in equity in the house. He wants to buy a new house down the street that just came on the market for $1.5 million. Now, he doesn't have a lot of liquid cash to go do that, and he wants to be able to make an offer on that property non-contingent. Okay, so he comes into me and he says, hey, or a broker, because we deal with brokers, can we do a bridge loan? So our bridge loan would be on his departure property. We would go 75% on it. So we would make a $750,000 loan. We'd pay off the $250,000. That would give him $500,000 to use as a down payment. That $500,000 then is used on the $1.5 million purchase. He puts down $500,000. We finance the $1 million. We do those two loans simultaneous. Now, the beautiful thing about our bridge loan is it has a 1-year term and it has no payments. The payment is due when the house sells. So it's intended to be a short-term loan, and most of them do pay off within 60 to 75 days. So, but they get the capital immediately. They're able to get into their new property. And so the fact that is no payment is what makes our product unique. Okay, you see a lot of bridge loans in the industry where the lender will say, okay, we'll help you buy the new property, and we're going to blanket lien your old property, and we're going to make one giant loan, or keep that first mortgage on your departure in place. So you have to make 2 payments. We don't do that. So when people come to understand our bridge loan, they think, wow, what a home run of a product. And it is one of our hottest products. I mean, people love it.
Yeah, well, I can definitely see. I mean, especially in today's inventory issues that we have with multiple offers. If we go to one person, or if we go to the listing agent with 2 different people, this one is contingent upon the sale of their house. This one, they're good to go. I mean, that's the beauty of it. That's a no-brainer. Yeah. How about are you seeing a lot of foreign nationals? Is that still coming into play?
Yes, I wouldn't say it's any more today than a year ago or 2 years ago, but we still do a fair number of foreign nationals, mostly in Florida or California. That's where most of the foreign nationals we see, and sometimes we see them in Texas as well. It's there's a lot of people that have exited that market. It's not a real frothy market at this point in the game, but we will do them. We most of them are done on a DSCR basis, which means it's a cash flow loan on a rental property. But we do have the ability to do second homes as well. We usually cut that LTV back by 5%. And that's because on a second home, you are looking at income and you're using foreign income and foreign credit. Of course, on a foreign national, usually you have not much credit at all.
Yeah.
So you have your four legs of the stool, if you will. You're kind of lacking on the credit front and you're thin on the income front.
Yeah. Yeah.
So that's why you pull the LTVs back.
Yeah. So in the again, the title of this article was capture attention by doing what others didn't. And I think so, so far we've identified these three areas. So number one would be the bridge loan. So I love those. Number two, the non-warrantable condos, just grabbing something else. And then number three, having a foreign national loan, kind of like having arrows in our quiver, different tools available to us to do that stand out. What strategies would you recommend for mortgage originators looking to take their business, increasing it for the year coming up? What's one or two things you think they could focus on?
Well, knowing all of our products is important, but it's funny that in that article I talked about those three items, but the truth of the matter is the meat of what we do is bank statement loans. And I find that most brokers, they're a little bit intimidated by a bank statement loan because they're used to putting data into an AU engine, and the AU engine comes back and says yes and send me these conditions, and it's real easy. Just hand it to a processor. And so people are intimidated about bank statement. Oh my God, what are you telling me? I have to analyze these bank statements and then come up with an income number. And we try to make the process very easy and less painful. So we can turn around, basically give you an income number within, frankly, within a half hour or so. So, analyzing 24 months bank statements, we can get through that fairly quickly. So having that confidence around, okay, if I can't get full doc income, that doesn't mean you have an automatic no. You should be talking to a non-QMAE. And that person should be trained in underwriting, our knowledge of our products. So to me, you start there. That in turn, when you start there, then you say, okay, now that I understand that, and you have all of these other products that you're not used to selling. So for example, if I walk into a realtor shop, there might be 5 people in line to do a presentation in that real estate shop.
Yeah. Yeah.
It's fascinating to me because every one of them are pitching the same thing until I get up and speak, because I'm talking about things that are very different. These first 5 we're talking about, I've got great speed, I've got great rates. They sell a homogenous product, and that's really all they have to sell. So they're selling the same thing. With me, we don't sell a homogenous product. I'm talking about, let me talk to you about a bridge loan. And when you start talking about a bridge loan to a realtor, their eyes just like, you're kidding me. Same thing with the bank statement loans. They're not used to bank statement. What does that mean? What do you do? And then all of the other products. So it gets their attention. But then in terms of sources, I mentioned banks. I mentioned financial planners. All of those people are really, really good folks to call on. Attorneys, lots of different types of attorneys, tax attorneys, bankruptcy attorneys, divorce attorneys. They all are potential opportunities for someone to get referrals from. Yeah,
definitely. It definitely opens the door a lot more when instead of getting pigeonholed into the main 3 of Fannie of a conventional FHA or VA. So good stuff. Hey, Joe, is there something I should have asked you today that I didn't? Did we cover it okay? Did I miss anything that you can think of?
Actually, you asked all the questions. you asked me to talk about things that are really hot items for us. At the top of the list, I mentioned the bridge, but I think some people miss out on the bank statement piece. And that when I get to talking granularly with a broker and I start talking about bank statements and the bank statement process and our process, which is very broker friendly. Our AEs are very well trained, very schooled in underwriting. They know how to structure loans. We're very good at helping, a broker, create a loan out of something that they don't think is a loan. And so that's what we do. We do loans on the edges of Fannie and Freddie, and that's a little mysterious sometimes to brokers, but we're good at it. We've done it for a long time, and we've closed a lot of loans.
It sounds like there's a huge advantage for the loan officers to keep up with the ever evolving industry, to ensure that they're offering the most relevant and beneficial loan products. Joe, if somebody wants to reach out to you or somebody on your team to find some of the different arrows they can put in their quiver, what's the best way to do that?
Yeah, so it's LendSure.com. My name's Joe Lydon, spelled Lydon. LendSure is online. You can find us that way. We've got a footprint that runs across America. We have employees in most states. I wouldn't say we don't have any one dominant state, but the bigger states, the Californias and Floridas, we're definitely have a presence and we do a good job of it. That's how you get in touch with us.
So sounds good. Joe, thanks so much. I appreciate your time. Good thing on the article. I know you've done other articles in there. We'll certainly be looking out for you. So thanks for hanging out with us, buddy.
Carl, appreciate it. Nice meeting you. Take care.
All right. Sounds good. All right. For our listeners, hey, thanks so much for listening to the podcast. We really appreciate it. And again, this was in the October edition of the residential side. Be sure to go check that out. And myself and Joe and the team over at the Scotsman Guide would love it if you would forward this episode to 3 of your loan officer friends. They'll thank you for it, and certainly we will too. So without further ado, thanks again for being here, and we'll see you on the next episode of Author Showcase. Thanks again, everybody. Bye-bye.